everybody on this call, you have Rawitch. You know, I'm flipping through some screens as I talk. I see a lot of mortgage coach professionals putting this on their desktop. More than ever, I'm seeing that. But you know, I'm going to announce a new feature that some of you may know, some of you may not know. But in the commentary, you know, everybody on this call, you guys know Dan Rawitch. I mean, he's providing this awesome morning update. You can now click the share button in iOS, and you can share that with realtors. You can email it, you can text it, and there's even a Facebook button. So I did want to, one, make an announcement of that new feature. I also wanted to make an announcement that Kristen has agreed to create an awesome, you know, Ask a Millennial video a couple times a month. So, you know, we don't know whether this is going to be, you know, 2 times a month, 3 times a month. Kristen's like, I don't want to commit to a time because I don't want to create noise. I want to provide the mortgage coach community with a video when I think it's awesome. So another new feature, we've got Kristen's, you know, Ask a Millennial that will be in here. And the whole thing is being shared. You can share it with your realtors. One click of a button, you can Facebook it, you can email it, you can text it. So with no further ado, you know, Dan has been creating, you know, I think some of the industry's best content for many years in Mortgage Coach. You know, his daily updates, they're timely, they're relevant. And when you think of transparency in our industry, I don't think there is a executive, a leader in our industry that just shows up with more authenticity and value than Dan. So Dan, I'm really grateful for your day-to-day updates in the Mortgage Coach community. And I'm going to pass off the screen to you and look forward to you providing with the Mortgage Coach community an awesome update that will help them and something that they can share with their realtors.
Great. And before I jump in, Dave, I just wanted to tell you I'm going to co-host a video with Kristen. She doesn't know this yet, but she's going to be doing Ask a Millennial. I'm going to be doing Ask a Grandpa. And I think that will really give a lot of perspective.
There's no way you're grandpa, but I would love to
I'm going to be a grandpa in April.
Wow, congratulations.
Thank you. I'm pretty excited.
You don't look it.
Thank you. I like you. Okay, so am I ready to roll, Dave?
Rock it out, Dan. Looking forward to it.
All right. First live, this is my baby Otis. You all know Otis. See the black on his face? He literally ate the entire ceramic fireplace log in our fireplace. This was a couple weeks ago, and my wife is just screaming at him, saying, "How stupid are you?" So I said, "I'm really sorry, but I have a lot of anxiety about the Chinese stock market." All right, so I like to critique myself. As you know, I've been doing this annual forecast every year for, gosh, a lot of years. I've been using the same model virtually. Well, not virtually. I've been using the same model every year, and the model's been incredibly accurate. Now, one of the reasons the model is very accurate, and this is why I was really happy to be paired up with Kristen today, is my entire economic point of view, all my forecasting really derives from what I call the 49-year economic lag. And that is that humans move in cycles. As we age, our buying preferences change, our habits change, and so it's easy to overlay that filter, run everything through that filter, and you're going to tend to be more accurate, and you don't get caught up in all the daily noise. I mean, that's why when the market's saying, oh, you know, the Fed's going to do this and rates are going to do that, and I say, yeah, the Fed's going to do this, but rates aren't going to do that. I feel very confident when I say those things because my filter is, what's the demographic of the population doing? And if the baby boomers are getting older and not buying as much, and the economy's not going to pick up again until the millennials hit their peak buying age. So that's really, demographics is where it's at, and studying the millennials and understanding that whole sector is going to be huge for you. So this is what I said last year. This is exactly the slide I showed last year, and it talked about China masking some problems. Oh, guess what? They really were masking some problems as we watched the Chinese market. I said Europe was weak. That's only beginning to show itself. Watch what happens to Germany in the next year or so. Big trouble coming there. We have worldwide rates sub 1%. Again, I did this over a year ago. The German bond is now 0.23. Think about that for a minute. It's actually a negative interest rate when you put in inflation. I told you that there were more deflation concerns and inflation concerns, and I told you that I believed that there was an oil bubble created by the Fed, and when I did this, oil was at about $70 a barrel. And that time, I forecasted I thought oil would touch 30s, and it has now. It's in the 20s. And I said, this is where I was wrong last year. the 10-year would drop below 1.5%. It would stay there for a sustained period. Now, the reason that I was wrong was actually it's just a miracle because it's never happened before. That was a joke. Was because of this whole Fed talk about the Fed increasing rates. And so the market got overly focused on that. But I wasn't. I kept saying it doesn't matter what the Fed does. The long end of the market's going to do what the long end of the market does. But the rumors and talk overshadowed any sign of reality. I said there'd be no income growth, retail sales would fall. Man, that's sure happening. And I reminded everybody that historic recovery, always throughout history, back to the Depression, has been a GDP in the 5% or above range. Heck, we haven't seen over 2.5%. I think we touched 3% at one time. So this has never been really an economy that's recovered back from '08. So what's changed since that slide last year? Nothing good's changed. Oh, by the way, a lot of these first slides have a little bit of a negative tone to them, but stay with me because this plays into, I think, one of the best times that we will ever experience in our industry. I've long said that we are the morticians of the economy. It's kind of sick, but it's like, hey, unemployment was up, woo! Rates are going to go down, we're going to refi. So we're a little twisted in that regard. So, and I don't see the world crashing. I don't see, a major currency crisis. So keep that in mind. There's some negative twist here, but it really plays into what I think is going to happen in terms of good interest rates and good home buying. Chinese stock market's crashing, no doubt. The Fed's recently released inflation model calls for 1.4% inflation. That's not enough. And I believe that we're going to see something more like about 0.5% inflation. And that starts really fearing deflation. And deflation is the greatest curse. It's destroyed Japan over the last decade and a half now, and you're watching it come through other countries. GDP is likely to be revised down below 1%. I think we're going to see GDP down around 0.3, 0.4, which again is sliding into recession. I actually believe we might really be in a recession right now. We just don't know it yet. The S&P aggregate companies, we take all the companies in the S&P and you put them all together, they're showing declining earnings and negative profits. Wow. And again, this has been known for a long time, but the market was snorting crack every day that the Fed was laying out on the table along with the razor blade. That's over. The market's not snorting crack anymore. Smoke and mirrors are being used to prop up stock prices. I don't have a lot of time to go into this, but I will tell you that I took a short position on IBM. I voted against Warren Buffett about 9 months ago, and it's been an amazing trade. Why? Because IBM stock kept going up, yet their sales kept going down, and I said, why? And when you really looked under the covers, you could see that IBM had been buying back all of their stock, taking all their cash, buying back stock, which the market foolishly loves. But when we see a company buy back its stock, that says to me they don't have anything else to do with their money. They have nothing good to do, so they're just going to buy back their stock. When you buy back your stock, you have less shares, and you take your earnings, divide by those shares, and it actually makes the stock go up. But in fact, it's a dying company. I don't want to vote against Big Blue, but that's kind of what's happening. They got to figure it out. There's a lot of companies taking that strategy right now. They can't grow their sales, so they buy back their stock. Oil, $35 per barrel. This is when I did this, and I said heading to $20 in my opinion. Well, it touched 20 yesterday. And then the oil fractors, these are the guys that are drilling for shale oil in the Dakotas. They are beginning to default on their high-interest bonds. I'll go into more of that later. And the junk bond market is melting down. Any non-quality bond is getting hammered. So there's going to be a continued flight to quality into mortgage-backed securities and the 10-year. And I think the 10-year yield, I say that we are the best-looking house in a bad neighborhood. U.S. Treasuries make the most sense. We're paying the highest yields in the world. And I think that from a full-on picture, we literally are the best-looking house on the block. And then corporate debt is a huge concern. It's 140% higher than it was during the Great Recession in '08. So companies are more leveraged than ever, which means they're less prepared for what's coming, and that's slowing sales. Rents are skyrocketing, and it's forcing millennials to buy homes. That is a fact. Now, I'd like to talk a little bit about how the Chinese buyers have impacted our market. And this is a quick slide on what's been happening in Chinese real estate. This is their home prices back in kind of going from 2015 through. And you can see that it just kept falling and falling and falling and falling. So that market's getting hurt. And because the Chinese market's been hurt so much, they're starting to pull out of California. And so you can see in the past, Chinese exceeded all other foreign buyers by a huge amount, $30 billion in real estate purchased versus 10 and 8 and 5 billion from some big countries, by the way. This was a quote from a local builder, Shea Holmes. He said that he's seen a significant slowdown in Chinese buyers in Orange County. The buyer is really drying up. He says, I don't think that's a bad thing. I think it's a great thing. Nothing against Chinese coming in to buy real estate, but you got to admit, man, those guys pay with cash, and that just doesn't help our business. So you take a 30%, you take 30% of the market out. That's going to help our buyers with inventory. It's going to take a little air out of the sales, which we need, and it's going to create more loans for us to do. So I really think it's a good thing, and it's a more normalized thing. I did this slide on December 30th, just to put things in perspective so you can see when I did my annual forecast. GDP was 2.5%, S&P was running at 2,000, gold was 1,000, and oil was 36, and the treasuries were 2.3. So a lot of what I'm predicting in this forecast is actually already played out. The question is, will it continue to play out? Okay, inflation, I'm going to breeze through some of these slides. This model says that inflation probably is at about 0.5%, and maybe throughout the year we slowly claw our way back, into the 1.5 range, and then by the end of the year we should see a little bit of increases in inflation. What I get a kick out of is I hear all these economists saying inflation cannot stay this low. It's not normal. Inflation always goes up, and to that I went back and I found this 100-year chart on inflation, and as you can see here, from the 40s through into, say, the mid-70s, this was a really ugly time I got in the business here, guys. Inflation for, 30 or 40 years was near 0%. That is not abnormal by any stretch. What's abnormal is what we saw since then. So I think that this is not unheard of, and it could very well continue for the next 15 or 20 years. And you're just not going to have high interest rates when you have low inflation. You really can't, actually. And then I also like to talk about long-term interest rates. Long-term interest rates, yeah, we say, oh, they're so low, how can this be sustainable? Once again, I show you from about the mid-30s to about the mid-70s. Sorry, this one's about the mid-60s. We had interest rates about where they are now. They're a little lower now. And guess what, everyone? Does that correlate with the inflation chart I just showed you? Yes, of course it does. So inflation is such a big driver in our lives. Now, what drives inflation? Employment growth. That's going nowhere, in my opinion. I think you're going to continue to see very few jobs created, and in fact, you're going to start seeing negative creation in the job world, which is going to play into my interest rate forecast. We'll see how that pans out. U.S. retail sales, I think they're going to continue to fall. This again plays into the GDP forecast and why I think we might slowly, if not already, slipped into a recession. That's not that bad of a word. We've grown up thinking that's the worst thing in the world. Now, a horrible recession is horrible, but a mild recession is mild, and it's not that bad for our industry. You don't want to see people out of work, but the alternative is full employment and massive inflation, and things get out of control. I love this slide because everybody is talking about housing starts and how phenomenal they are. And so what I will tell you is, yeah, they're going to stay phenomenal, but then I hear people saying, well, they just can't stay this good. It's too good. Look at how much we've climbed. Yeah, look how much we've climbed since 2009. Check this out. This is where housing starts have been for the last 50 years, way up here, right? So if I were to draw a line kind of across to create an average, I would say average housing starts is somewhere around 1,600 homes. We're barely trying to push 1,200 homes. So as good as we think housing starts are, especially the millennials, because their economic horizon is kind of, typically most of our economic horizons begin when we get out of college. But so much has happened before that, obviously. So this is not as good as we think. I think that housing has got a long way to go before it fully recovers. It's a good thing for our business. Oil, I think it continues to fall. You can see my forecast takes us down into the 20s. And then sometime in 18, it starts climbing back out. But in the meantime, there's going to be such an incredible massacre because these fracking companies cost them about $70, $75 a barrel of oil to pull that out of the shale. It was such a boom industry. I mean, you have these oil workers literally like covered in grease driving Rolls Royces in North Dakota. It is highly leveraged. All the fracking companies borrowed significantly. They have huge debt with high interest rates, and now they're creating oil that costs them $75 a barrel, and they're trying to sell it for $25. You tell me, how long can that last? It's not. So they're starting to default on their bonds, and that's going to create, I think, more of a junk bond crisis, which plays into lower rates. The Fed funds, I actually don't believe this slide anymore, although I just did it about a month and a half ago. This showed the progression of the Fed's 4 increases, trying to get Fed funds rate back to 1%. My strong belief was sometime mid to the end of the year, they say, whoops, sorry, and they have to cave it all the way back down. I don't even think they get that high anymore before they say, whoops, sorry. I think they might even say, whoops, sorry, in the next quarter or two. We'll see. But once again, Fed funds rate, who cares? It does not have any effect on long-term interest rates. It just doesn't. That's probably a longer story. And so the thing that you all care about most, what does that mean for mortgage rates? What it means is they're still really high, and they're going to get a lot lower, and they're going to continue to fall throughout the year. And even as they start increasing into, and this, by the way, this takes you all the way through 2017. So really into late 2017 is when you start rising, and 2018 they get kind of high. But this is because of the whole demographic belief that I have that the millennials will reach more of their peak buying age. I want to take a minute to just talk about those demographics and put them into perspective for you. So the crash happened in 2007, correct? We will call it 2008. Now, my belief about demographics is that, and this has been proven through a lot of research, that humans reach their peak buying ages at 49 years old. So in our 40s, it's still about bigger, better, fancier, right? And about 49, something shifts, and I hate that it shifted in me because I still think of myself as a young-hearted guy, but it shifted, and I didn't care about a big house anymore. I cared about a 10-year mortgage instead of a 30-year mortgage, and I was fine having a smaller home so I could get that 10-year mortgage with the same payment as my big, stupid house had on the 30-year mortgage. I didn't care so much about fancy cars, but I still love cars. I still love toys. But my peak buying absolutely started tapering down at 49 years old. Now, guess when the largest population of baby boomers hit age 49? 2007. So it's no coincidence that this market crashed. We can blame the subprime. Yeah, it had something to do with it. This next crash, we'll blame the oil fractors. But I'm telling you, it has more to do with the aging demographics. The reason that I say Germany's about to get in big trouble, they just went through their 49-year demographic, and the plunge begins, and they have this huge problem with just massive amounts of people migrating into that country. So their stuff's coming, and once again, that'll help our interest rates. This is a great slide. What this tells you is what's happening today, and I've talked about this slide for a long time, and it's the reason, again, why I don't get so moved by all the noise and all the, the Fed's doing this and all that. And I just really look at long-term movement. And this interest rates, the 10-year Treasury has been in a long-term downward channel since 1989. Now, there are times where you think, oh, my gosh, rates are out of control. But guess what? They're not. We're still in the channel. And so sometimes a big movement is actually healthy because we got to go back up and test the channel every once in a while. And so you can see where this channel leads you. And so when I say I think we're going to see a 10-year bond around 1.2, 1.15, all I'm doing is following this channel down. Now, could we get a small spike before? It's possible, but I'm not as concerned about it because there are a lot of people that thought that the taper tantrum, when everybody's crying about the Fed tapering, selling off their bonds, they thought that that was going to drive us to the top channel. It didn't. Now we're fearing central bank selling. I'll show you a slide why that's not a concern for mine. But even if we did dip up a little bit, we're still in a long-term move down. So I'm almost done here. This is who holds our bonds. And as you can see, back in 2000, only $900 billion in bonds were held by foreign countries, both developed and emerging. And as you can see now, 6.2 trillion, 11 times, are held by foreign countries. Now, most of these countries, believe it or not, are emerging. You can see the gray line is emerging. These are countries that are just having good times. Life is good. They got to put their money somewhere. We are a great bet. Some of the established countries developed, we might see a little bit of selling here, but this is just a drip in the bucket of overall treasuries being held. This slide kind of tells you the same thing. And what you have to keep in mind is this whole bottom half of this people that hold our treasuries, they're not going to sell them. The Fed and the government do not sell treasuries, contrary to what people believe. Yeah, there's been some tapering, but overall, the Fed just kind of makes them go away. They don't necessarily dump them into the market. And here's proof of that. So this is a 12-month rolling sum of net purchases. All the fear and all the taper tantrum occurred here. But as you know, the Fed was just dumping. They got back in to buy a little more. They've been dumping like crazy. And what's happening? Rates are going down. They're not going up. So this is such a vast market. I don't care what the Chinese does. I don't care what India does. I don't care what our Fed does. There's a lot of treasuries out there, and we are the best-looking house in the not-so-great neighborhood. GDP, again, my slide shows is getting down to almost 1. Things are happening so fast right now since my forecast. I almost need to update this because I think this gets us closer to 0 before it turns up again. All right, so in summary, I want to wrap this up for you. GDP, retail sales, inflation all dip. The dollar will soar, and that's going to put more pressure on exports, which is going to hurt GDP. Corporate debt is higher than it's been since 2008. U.S. bonds are in very safe hands. The Chinese debacle will take the air out of home prices. It's going to bring back affordability. Fed is forced to say oops and pull back rates. Junk bonds will probably crash much worse. The 10-year will hit record lows and continue down because we're the only safe haven in the world. And a possible spike in rates when junk bonds first crash. People might say, oh, all bonds are bad. But the fact is, they're going to figure out that you got to get the quality. 10-year continues. There's a 26-year ride down the channel. I don't see that stopping. And then now for my shameless promo, I'm gonna let Dave really run with this one. But I love that I was matched with Kristen. In fact, I want to talk to Kristen afterwards to see if there's other ways we can work together. Because my demographic beliefs tie so closely into the millennials, I'm going to be speaking at some live events, and Terry Shodine is going to be the primary speaker. And Terry is a best-selling author of a book, Small Message, Big Impact. She spoke at our sales rep. She's amazing. And she really talks about each generation, from the great generation to the boomers to the millennials, done tons of research. And so we're kind of paired up because, again, my economic viewpoints have a lot to do with demographics, and she's going to talk a lot about that. So those events are going to be in San Diego, Inland Empire, and in San Ramon, and I think Dave's going to share more with you on that. And the last thing, I wasn't going to share this, but there's a quick flyer on the event. Sorry, Dave. I have this in there because it's something I did for my company. I was asked, we work with building champions a lot, and Greg Harkavy said, hey, let's create a one-word vision for what this year is going to look like for your region. And I came up with the word magic. Now, magic is a very special word to me because you guys all know that I love to sail and I love my boat very much. And about, 4 years ago, my daughter was 12 and 12-year-old was snotty. And we were driving to San Diego, and she was bitching all the way. And she said, why do you even need a new boat? You have a boat. And I said, honey, no matter how old we get, we still need some magic in our lives. When I got to San Diego and looked at this boat, the boat's name was Magic. And my wife, who really didn't want to buy a boat, grabbed my shoulders and said, oh, my God, I have the chills. You're supposed to have this boat. And I said, yeah, baby. So I turned magic into an acronym. And so real quickly, here's what it means to me. And you guys can have this if you want. We're going to be hanging it in all of our branches. M motivates those we touch. We all have the power to lift one another up. And I think we have that obligation. Don't drag down. Lift up. Adopt and adapt. We can't control the changes in the economy, but we can adapt we can change what we do about it. We have to grow. If you don't grow, you're going to die. Infectious enthusiasm. Our attitude is infectious, so you might as well bring enthusiasm to the table and not some downward, gloomy point of view. And the last thing is control your own destiny. Don't let the market define you. It's great I'm saying all these great things. God forbid I'm wrong about everything I said. Who cares? Winners win no matter what the market is. You don't want to be the guy that only succeeds because the rising tide lifted your boat. Make sure you control your own destiny. I'm done.
Boom! Man, what an awesome call. Kristen, you completely crushed it. I've been getting text messages, chats. So are you still with us, Kristen? Because, you know, Millennial
Yes.
Kristen, you're not
Hey,
Facebook.
Millennials gotta go.
I got things to do.
So-
No, this is an incredible presentation. I'm going to rewatch this. Thanks so much, Dan, for sharing. That was awesome.
So by the way, do millennials like, you know, this type of nerdy knowledge? You know, is this attractive to a millennial?
Yes, that's actually, I was going to say, I mean, even some of this information you could share with consumers and we would eat it up. I mean, we want as much information as possible. We might not understand it right away, but if you explain it and, but yeah, putting those graphs out there and explaining exactly why rates are falling or why now is a good time to buy, or that maybe a couple months ago was a little bit better. I mean, just being transparent and sharing this kind of information is really awesome with millennial consumers.
Beautiful. So, and by the way, so do most Xers, so do boomers. We all want to work with an expert. And Dan, your commentary and your update is a complete gift. I'm grateful.